Ladies and gentlemen, welcome back to the Master Investor Show 2020, which takes place entirely online this year. In the next session, we have the pleasure of welcoming two prominent investment professionals. That will be Stephen Tredget of Oakley Capital Investments and Simon Gergel of Allianz Global Investors. Thank you.
Hello, and many thanks for joining us for today's presentation on investment company Oakley Capital Investments. My name is Stephen Tredget. I'm a partner at Oakley Capital. And first, let me explain the relationship between these two entities. Oakley Capital manages private equity funds. They identify and they manage equity investments in private companies, whereas Oakley Capital Investments, or OCI, is a publicly listed company which invests in the funds that Oakley manages and allows private investors like you or I to gain exposure to private equity returns through the stock market. So OCI is a direct PE vehicle, listed PE vehicle committed to one manager, similar to a 3i or an HGT or an Apax Global, and in contrast to a fund of funds who commit to multiple managers. So to give you an immediate flavour of the type of businesses that OCI gives you access to, here is an Instagram screenshot posted by a student studying online. Now, this isn't obviously groundbreaking given the experiences of this year, but the students in Japan, they're studying an English language career-orientated degree, and it's a course designed and delivered online by German university IUBH, which Oakley funds have a majority stake in. The key is it's a study program that is created for this channel. Unlike a professor trying to deliver a lecture over Zoom, it's completely flexible, student-orientated learning, and it's one of the largest and fastest growing universities in Germany today. It's also just one of the examples of digital businesses that make up the Oakley portfolio of companies. Companies that have benefited from the impact of COVID-19 accelerating technology trends, with digital tools becoming increasingly popular B2C and B2B solutions. So in the course of the next 15 minutes, we will attempt to outline why should any investor want exposure to private equity, kind of what is Oakley Capital and how does it make its investments, and then finally, and as importantly, what's the OCI opportunity here and how has it been impacted positively or negatively by COVID-19 in 2020. So first up, why private equity? And I guess there's kind of three high-level reasons. One is the returns it attracts or achieves. Two is that unlike public market investors, PE investors play a meaningful role in the creation of value, so have significant control over the outcomes. And thirdly, it captures a much larger pool of companies, so presents a greater choice and opportunity. And to that point, here on the screen, you'll see a chart which shows in the US, but it's played out globally. In the lighter green there, the increasing number of private companies backed by private equity over the last 10 years, and in converse, the decreasing number of companies that are in the public market. And what's leading to this trend? Why are more companies staying private for longer, or in fact staying private for their entirety? And that's because, I guess, one, there's just a lot more private capital available. 10 years ago, this was a very kind of nascent industry. The other is, as a private company, a private capital, private equity investor kind of doesn't just offer you capital, they offer you kind of support skills and expertise that enables you to grow and to push on to the next level of revenue or earnings. In contrast to public markets, well, they're burdened by increasing compliance, increasing cost, M&A restrictions, controls around management incentives, the kind of pressure of live pricing and a lot of short-termism that comes with attracting public market shareholders. But I think most importantly, you give up the information advantage that you maintain as a private company. Now, to demonstrate whether or not PE returns are attractive, we've got here on the screen the FTSE All Share as just as a crude but an example of kind of public equity performance over 1, 5, and 10 years, and as a guide to what kind of global private equity has achieved in terms of its asset growth. Here in the second bar is their performance over the same period. Now, of course, we are public market investors, i.e., the audience here and myself, and so the way we can get access to that is via the listed markets. And so, how has the listed PE market performed? Well, we're going to use LPX Europe as an index that tracks the listed PE constituents here in Europe. And as you can see, it provides a decent proxy to global PE performance over those time periods. So then lastly, how does OCI compare to LPX Europe, kind of better or worse? And overlaying on that chart here, you see OCI, and you'll see that actually it is in the main actually outperformed LPX Europe, the index, and as we'll look at later, it's one of the best performing listed PE companies on the stock market. So does that asset performance, that asset growth, translate to share price performance? And yes, certainly looking here since OCI's inception in 2007, you'll see the shares kind of dramatically outperforming the FTSE All Share, and kind of most notably, it's made up any kind of lost ground that happened from the kind of the crunch from the kind of first lockdown back in March. So who are Oakley Capital? Well, we've established that they're a private equity manager of funds, and let's look at kind of what they focus their investments on. So they're very much a mid-market investor, and what do we mean by that? We mean that companies that are up to 400 million enterprise value, and we go down to much lower levels, maybe around about 100 million euros of enterprise value. We're very much focused on Western Europe, particularly as we'll touch on a bit later in Germany, Italy, and Spain, and France. And in terms of sectors, we specialize very much in technology, education, and consumer. But overlying that is a really strong digital theme. It's 75% of the companies within the portfolio, there were 17 in total that you access by buying OCI shares. 75% of those deliver their products or services via some form of digital platform. Notable as well in terms of characteristics of those companies is that 70% of those enjoy some kind of recurring or subscription-based revenue, or we've identified an opportunity to bring a subscription nature to the revenues of companies we've acquired. The key factor of any private equity firm is how you originate, your ability to identify and acquire at attractive prices private companies. And absolutely fundamental to that, Oakley, is our relationship with business founders. Oakley Capital was founded by a serial entrepreneur, a very successful one. He ultimately, essentially in Oakley Capital, wanted to create a vehicle that was a financial partner that he felt he never had as a business operator, feeling that there was a lack of understanding of the challenges and the distractions that were involved in running a business. So as a consequence, there's a lot of empathy and understanding around businesses, and as a result, business founders tend to respond incredibly well to us and are attracted to having us as a partner. We've got over 20 now business founders we've backed, and the great thing about entrepreneurs of these kinds, they go on to find and identify other opportunities. In some cases, we're backing some of these business founders for the third or fourth time. Also, and to illustrate the strength of the relationship, after they've had a certain level of success with Oakley, they've gone on to invest some of those returns back into the funds themselves. So 200 million euros of the assets we have under management actually come from those business founders. Now, obviously, with any PE, a lot of screening, a lot of analysis goes into understanding kind of the sectors that we excel at or adjacent ones, and particularly in our efforts to find bolt-ons. We have considering that we have maybe 4 billion under management, we've got a team of about 40 investment professionals that are working on not only managing our existing companies, but finding new ones and screening for opportunities. The other thing that Oakley notably does is that it's very happy to accept complexity and opportunity, and particularly that comes in carving out maybe a smaller business from a larger parent. So the notable things to say as a result of our approach is that over 75% of the deals we do are uncontested. What we mean by that is that they're not part of they're not intermediated, not part of some competitive auction. And as a result, there's a greater opportunity for us to find and uncover value as a result of that. In over 90% of the cases, we are the first PE investor, formal PE investor in an opportunity. And in fact, it's often been described to me that what we are typically doing is unearthing new opportunities, taking on board complexity, which maybe larger global PE firms don't have the time or inclination to deal with, and building and developing companies that ultimately become attractive to larger PE. They become of a size then they're attractive to larger global PE. Let's talk now about some of the investment themes that Oakley have focused on over recent years, and particularly on the kind of digital consumer revolution. Now, you'll be very aware of this and what that's meant in certain businesses to date. But let's go over that and see what it means in terms of financials. So typically, most products or services will rely on some kind of broker or an agent or a physical network or a wholesaler in order to deliver their product or service to the consumer. Now, of course, the great thing about digital channels coming along is that now, in many cases, a product service can be delivered directly to consumer. And the result of that is that it's frictionless. There is far less cost associated with that. To give you an example, an EBITDA margin for someone selling something via a retail network, a physical shop network, if they're lucky, is somewhere in the region of 10% EBITDA margin. Wholesaler, you might achieve 20 to 25%, but via a kind of an online or a social media channel, your margins are more like 35%. The other and a significant advantage of this digital revolution is the attractiveness and the measurability of digital marketing. Gone is the pray and spray approach that is really associated with kind of TV or radio or print, and that it's very hard to kind of measure what your returns are from any £1 of spend in any of those particular channels. Now it's absolutely clear what your returns are. And what that also delivers for you as a business operator is, for the first time, you know your customer. Data, one of the most valuable commodities on the planet. And finally, companies know exactly who their customers are, what they bought, when they bought it, what they responded to, what time of day, and what influence or what pound of marketing attracted them, and now have the opportunity to upsell other products or services or other things from their existing portfolio. And to state the obvious, the winners are the digitally native, those that were born in this environment and are really growing quite significantly as a result. Here's 3 examples of that within the existing portfolio. They include a guided fitness app in Germany called Gimondo, an online price comparison website in Italy called Facile, and as we mentioned up top, an online higher education firm in Germany called Career Partner Group. Let's touch on Career Partner Group a little more in just terms of understanding the advantages that an online served provision like this delivers versus the more traditional physical university. And I think most upfront, it provides so much more flexibility for the student. One of the things that enables them to do is maybe dual studies. It also enables the firm on that flexibility. IUBH can provide a much wider range of courses, over 100 courses, and respond very much year to year to the courses that are being desired by students and by industry in a way that physical universities just do not have that flexibility. A physical university as well very much focuses absolutely on its research and its reputation, rather than the kind of the customer satisfaction and the study success of students. I mean, it's just not customer orientated in the same way that most kind of modern businesses would ordinarily be. They're constrained by the classic classroom, and when they go into digital, they try to replicate the classroom, which of course isn't entirely appropriate all the time. The other thing is that, rather than just relying upon your reputation, a business like this can actually deploy some of the modern tactics of kind of e-commerce, CRM, and Google Analytics and targeting that most kind of modern businesses can. And the result of that, well, Career Partner Group, when we acquired it in 2018, had approximately 15,000 students and was generating over the full year about 16 million of EBITDA. Coming up to kind of 3 years on at the turn of the year, and the company will have over 60,000 students. There's only one university group now larger than them, and their run rate EBITDA at the end of the year is something more like 70 million of EBITDA. Another investment theme for us has been repeat plays in different geographies. What do I mean by that? That is looking at more mature markets. This is the classified markets, and you look to kind of UK, Australia, and Germany, where online property classifieds it's much more mature. We're all now very familiar, and no doubt most of us have used or perused Rightmove here in the UK, and there are very similar kind of equivalents. Now, in other geographies, and I include on this curve now, Idealista or Casa in Italy, or Idealista in Spain. Now, the markets are just as big. It's just the online penetration and kind of internet adoption is slower, and so the model is just so many years behind. As a result, their margins might be a tenth of what the larger, more mature players are, but the end opportunity is still a significant. One of the great advantages we've gone from the UK to, let's say, Germany, where Germany was less mature, and we've invested in digital businesses and enjoyed that growth period, and so we're able to repeat that opportunity in Iberia, even now looking to places like Poland, where a number of themes, e-commerce, online marketplaces, cloud computing, software as a service, is less entrenched, less introduced into those countries. So let's talk more now directly about OCI and the opportunity and the impact of COVID-19. Here on the screen is there's just shy of 700 million net assets in OCI, and they are split between that of the assets which are in the Oakley funds, or actually invested directly in the portfolio companies within that fund. And there's 430 million invested there. And it's that investment, particularly in the funds, that really drives the returns for OCI. The funds have delivered a net, after all fees, 25% IRR annually since inception in 2007. And we also hold cash. We have a much larger cash balance than we would ordinarily, at 261, nearly 40% of NAV. And this has come about because we sold 2 large assets right at the start of the year. Very fortuitous that we went into kind of lockdown and the kind of most significant period of kind of COVID impact. A lot of cash enabled us to, none of them needed it, but enabled us to provide support to our portfolio companies if any of them required it. But now it puts us in a great position. As Oakley Capital looks to deploy funds, it has Fund 4, it's got a flagship fund, it's about 30% invested, and is now investing into a kind of post-COVID environment. And typically funds of vintages kind of post-disruption or crisis tend to perform well. Morgan Stanley says that actually they outperform a typical fund vintage by about 68%. So we're in this very lucky position where Oakley has kind of funds that are just about being deployed, and OCI has a significant amount of cash that can be drawn into those funds if investments now come through at a fast pace. So here's a look at the asset value, but divided up by companies. So these are the 17 companies, and you can see the kind of broad split across the 3 different sectors. There are other kind of factors to kind of draw as well. Each of these companies will be market leaders in their chosen niche. Those niches will be enjoying some form of structural tailwind. And as we noted before, there's often a kind of recurring subscription nature to those revenues. A very brief example with Facile, I touched on it earlier. It's the #1 price comparison site in Italy. The structural tailwind is Italians' adoption of online marketplaces. To give an example, in the UK, 80% of car insurance is arranged online via an online marketplace. In Italy, it's 12%. And in terms of the recurring revenue, well, there's an annual trail fee that a car insurance broker pays Facile if a customer retains the product that they've purchased. So most notably, I guess what drives the returns is our ability of the companies to grow and to grow their earnings. Now, we might typically imagine these high growth businesses that Oakley's invested in to grow between their EBITDA between 25 to 30%. Certainly that's what we've achieved historically. There has been an impact of COVID and the average growth up until June this year was about 17.5%, showing that there has been some impact in the first half of 2020, but also illustrating that these companies are still growing despite that. Often talked about as level of debt deployed within private equity, and here you can see that we've kept a relatively modest level of debt on average within the companies, 3.7 times net debt to EBITDA. Now, I think the other important thing is it's a useless metric unless you know more about the companies. And I guess the important thing to say about digital businesses is they don't tend to spend an awful lot below the EBITDA line, other than tax. So a lot of that EBITDA converts to cash, and as a result, and it's growing quite fast. As a result, incredibly comfortable with that level of debt. In terms of average multiple, when you consider how fast those companies are growing, then 11.8 times EV/EBITDA as an average multiple is pretty conservative. The other thing that can give you some confidence in terms of the conservative level of valuations. Can I trust the NAV that any PE firm publishes, but that OCI publishes? And I guess one way of looking at that is, on average, when we've sold an asset, we sell it at a 34% premium to the price we're currently holding it at. So a 34% premium to the price that makes up that NAV. And also, I'd overlay on that there's actually no incentive for a private equity manager to overstate the value of an asset. They don't gain any more in terms of management fee or performance fee. The management fee is based upon the funds committed, and the performance fee is only achieved at the point of exit. So there's no benefit to overstate a value prematurely. Here's a quick graph to kind of show you in terms of how that fund has performed, how those companies performed during this year, and what the kind of COVID impact has been. And that first bucket, and the largest bucket here, is those companies that have been absolutely unmoved by COVID, i.e. they've either prospered or they've hit their budgets as intended in the year. And these are, the software businesses, web hosting businesses, education technology, or consumer digital applications, like the fitness app, for example. In the middle bucket are those that would have had some kind of impact, maybe because Facile, for example, you didn't have to reinsure your car during lockdown in Italy, so you might have seen a sales impact. But post-COVID, they've returned to their original budgeted run rates. In fact, some of them have caught up that ground. And the final bucket there are companies where there's some physical interaction required with the customer, either because in the case of Norsal, it's because it's got a retail network that it sells apparel via, or it's required regattas to take place in order for people to need replacement sales, or in the case of Time Out, a physical food and drink marketplace, disruption to which obviously still continues. Let's provide some headline numbers as we bring the presentation to a close. Net asset value we've talked about of OCI is just under 700 million, and a NAV per share of 3.56 pence. And as we mentioned early on, the annualized returns, so per annum, OCI has grown its NAV at 16%, and we'll compare that to the rest of the peer group in a second. In contrast, the market cap is actually just under 500 million, so trading or £2.60 a share, so trading at a significant discount to NAV. And I mentioned that premium that we achieve whenever we sell an asset. So let's put that in context versus our peers. We look here over 3 years, but it's a similar story over 1, 3, 5 and beyond. That OCI's annual performance is really up there in the top 3 of the listed PE. And in contrast, the discount to which it trades to its net asset value is significant. There's only a couple there that are either one's in rundown, one's a different prospect to us, and yet we're sitting, despite our outperformance. So to close, I think in terms of important messages for OCI, it's really the level of digital nature of the companies that are in the portfolio. The fact that those companies have grown in the current environment despite the disruption. The fact that OCI has a large pool of cash that it can deploy now into a potentially once-in-a-generation investment period that we might enjoy over the next 6 to 12 months. And to put that into context, Oakley Capital's pipeline is one of the largest that it's enjoyed in its history. There's about 160 prospects we've currently identified. And remember, just as importantly, a large percentage of those, over half of those, have been through proprietary origination, i.e. these are opportunities that we've identified ourselves through our business founder network or through our screening. The next news from OCI comes on the 27th of January when we provide a 4-year trading update, and most notably we'll be publishing an NAV which will reflect how the companies have performed over the course of 2020, and particularly updating on the second half of the year. Thank you very much for your time.